Hey everyone, it's Nate. Today I'm going to show you how you can legally avoid paying taxes. Check it out, it's going to be awesome. Let's get it. Welcome back everyone, my name is Nate and I'm here to help you master your money. So in recent days and in recent years as well, there has been quite a bit of talk about taxes. And the question in everyone's mind is, how do the ultra wealthy go about making millions and billions of dollars and not pay a cent of income tax? It's baffling, and it is far more complex than I can describe in a simple video. So if you would so kindly subscribe to the channel, so over time I can impart all of my tax, finance, personal money hacks and credit and investing and money related knowledge, all of that, I can impart that on you over time instead of trying to cram it into one video, because honestly your brain would melt, because mine is basically melted trying to figure all this out, and I've had years to study it. So subscribe and we won't have that problem. So little disclaimer here, just for the YouTube police. I am not a CPA. I am working on my CPA. This is not in any way financial advice and should be taken as entertainment only. Okay, so there really are two kinds of people when it comes to taxes. There's one kind of person who simply doesn't really pay any mind to taxes and just pays whatever they're told they owe at the end of the year. Person two is the kind of person that seeks to absolutely maximize the US tax system to his favor and knows and understands most of the tax rules that apply to him. So today I'm going to give you a glimpse into the billionaire's world where they make billions of dollars but pay no taxes. I'm going to explain to you some of the things that you can do personally to decrease your taxes. Some of these will only apply to those with higher incomes, but most of these can be applied regardless of who you are and what your current financial status is. All right, so this first one involves saving money, which is something we could all do a little better at, and that is going to be tied to a IRA. So a conventional IRA is tax deductible. What this means is if you put money into your traditional IRA account every year, and every year you have a cap of up to $19,500 that you can contribute to this account, when you do this, it is actually deductible from your taxable income. So when I say this is tax deductible, that means when you get your tax bill at the end of the year, this can decrease how much money you owe because you invested into a traditional IRA. For example, if you made $49,500 of income, hypothetically, and let's say you maxed out your traditional IRA contributions at $19,500 for the year, you could have a taxable income that is no longer $49,500, but will be reduced down to $30,000. This is one of the wonderful benefits of having a traditional IRA. So moving on to step two, in a similar function to a traditional IRA or a 401k, a health savings account, also called a HSA, can be deducted directly from your taxes if you contribute to it. You can contribute up to $3,500 per year to this account, and that will be deducted from your taxable income at the end of the year. Now, there's one little caveat to this, and that is you must have what's considered a high deductible insurance plan. You can go ahead and look that up in case you don't know what that means, but essentially you have a very high deductible on your insurance plan for your health insurance. That's really it. One super cool thing with an HSA though is that once the money has been put into the HSA and it's been deducted from your taxes, you won't have to pay any tax on it when you take it out. A traditional IRA and a 401k, when you take the money out of there, you have to pay taxes on the money. But with an HSA, you don't. It's basically tax-free money you can use for health expenses. And if there's one thing that I have learned from life, it is that you are always going to have health expenses no matter how healthy you are right this moment. Next week could be quite different. I hope that it's not, but you never know. So these next couple of items are going to apply to people that have businesses. And fortunately for all of us, business is a very loose term. So if you sell socks on Etsy and you make like $2 for the whole year, well, you have a business and you can write off a lot of stuff against that income. But if that is the case and you only made $2, it's going to look kind of weird to the IRS that you made $2 of revenue, but you had like $10,000 of expenses. So I would advise against abusing this kind of a system that I'm about to mention to you, because they will catch on pretty quickly and they will find you. But this is a thing to legally help you decrease your tax liability if you're trying to get a business up and running. So like I just mentioned, if you have a side business of any size, you can deduct any of the expenses that you incur working on your business, trying to build that up against your income. So for me personally, I have several little side businesses that I operate, like my insurance business, amongst other things. And so anything related to my insurance business, I can write off for taxes. So there's a laundry list of things that you can write off, but I'm just going to rattle off a few that come to my mind that are pretty common that you can use to help decrease your tax liability and maybe even have no tax at all one year. Mileage, advertising, travel expenses, insurance, interest, the list goes on. There are so many things that you can claim against your income to decrease your tax liability. And really, regardless of what kind of situation you're in, it is absolutely invaluable to have a good conversation with a CPA to figure out exactly what kind of things you can deduct and how much tax you can expect to spend. The biggest difference between the people that don't care to really know about taxes and the ones that know the tax system and use it to their advantage is a good CPA. Having a good accountant in your corner can be invaluable, and that's really the difference between a tax preparer and a accountant. So if there's any advice that I could give in this one video, the only thing, it is if you can't figure it out for yourself, the tax system, because it is complex, you pay someone to figure it out for you. It may cost a good bit of money up front, but if they're worth their salt, it is going to be worth it many, many, many times over. So this is one more thing with the business expenses. So if your expenses for your business are more than what your income for that business actually is, the loss that you incur can go against the rest of your income and decrease it as well. So let's say hypothetically you made $50,000 one year and you had a little side business, and that side business made you an additional $1,000. Well, one thing to consider with that business is that you spend a lot of money on getting business cards printed, on getting insurance for errors and omissions insurance. You also spent money on advertising, telling everybody about your company and putting on Facebook ads or YouTube ads, whatever it is, and you spent $5,000 in total getting everything set up and trying to get the ball rolling on your business. Now, if you compare the income you got from that of $1,000 to the expenses if you had of $5,000, you'll see that you'll have a net profit of negative $4,000. Well, that negative $4,000 doesn't just sit there. That goes to your other income as well and decreases your total liability. So, while in total you had $51,000 of income, because of that loss, that brings your taxable amount of income down to $46,000. So up next is going to be depreciation. Now, it's kind of a hard thing to explain. Simply, depreciation is recording the loss of value in assets that you use for business purposes against your income. For example, if you have a car and you use it half the time for business purposes, you can write off half of the eligible possible depreciation against your income for that car. So for example, if you buy a car for $20,000 and it has a salvage value of $5,000, that gives you up to $15,000 that you can depreciate over the course of 5 years. We are going to use the straight line depreciation method, which essentially takes the same amount of money every year and depreciates it against your vehicle. Straight line simply means the amount that's being depreciated on the asset that you have is equal every single year. So if we have $15,000 that we can depreciate and we have 5 years to do it, that gives us up to a total of $3,000 per year that we can depreciate against our income for that business. But we need to consider that we're only using the car half the time for business purposes. So we can't claim the $3,000 per year, but we can claim up to $1,500 per year against our income. So now when you have a car, there are expenses that come up. Because you use this car partially for business purposes, you can write off the expenses you incur on this vehicle up to how much you use it for business purposes. In this example, we're using the car 50% of the time for business purposes. So you can write off 50% of eligible expenses as well as the depreciation against your income. These things in combination is what takes people's taxable income and makes it almost zero. So moving on, this is going to be absolutely the number one factor in making a millionaire. And that is buying real estate and using it for investment purposes. So one of the best things about using real estate for investment is going to be the fact that you can depreciate the value of the properties that you have over the course of 27.5 years. So for example, let's say you have a home that you paid $250,000 for. If you depreciate that over the course of 27.5 years, you'll be able to write off $9,090 per year of depreciation against your rental income. So if you own this house and you're renting it out, and let's just say you're making $1,000 a month net on this rental property. End of the year, you have made $12,000, but you're not going to pay taxes on $12,000. No, you will not. You will apply the depreciation that you have of $9,090, which leaves you with a taxable amount of income on this property of $2,910. That literally takes 75% of the income here and excludes it from being taxed because of depreciation, because of all the rules and tax laws that are available and usable when it comes to real estate. The tax rules with real estate are absolutely ridiculous, so I would absolutely recommend as early as you possibly can, buy real estate, invest in it as soon as you can. They did a study and they showed that most millionaires made their money, made their fortune by investing in real estate. That was the number one thing out of anything else. Buying real estate, investing in it is the key to it. That's it. So one additional little thing that you can use to your advantage to decrease your tax liability is going to be to take advantage of geographically different tax laws. So this is what I mean by this. Certain states actually don't have a state income tax. If you live in the US, you're going to have to pay federal income taxes, but if you live in certain states, you won't have to pay state income tax. Now, there are several states that do this, but some of the biggest ones are Nevada, Texas, and Florida. So if you're coming from states with very high state income tax rates, you could potentially save up to 13.3% per year on your income. Like you get more of your income to keep just by living in a different state. So going beyond this even further, have you ever heard of a Swiss bank account or maybe even a Cayman Islands bank account? Well, the reason you probably maybe have heard of these as some fancy accounts that you can hold your money in is because there's a lot of tax laws that are very relaxed in these countries. So let's take the Cayman Islands, for example. They have a 0% personal and business income tax rate. This means if you incorporate a business there, you will pay zero taxes for the income that you have. So, hypothetically, if you were to have a little business in the US, and let's say you knitted some sweaters and put them on Etsy. I'm kind of plugging Etsy today. Don't hate me. Etsy's kind of cool. They got some neat stuff on there. So anyways, you're knitting away, making things for Etsy, and you don't want to pay taxes. Well, there's some ways that you can potentially not pay taxes on the money that you make from Etsy. So if you were to incorporate your company here in the US, and then you were also to incorporate another company in the Cayman Islands, and let's say that Cayman Islands company licensed some intellectual property to you on some very advanced knitting techniques, and they have a royalty of 100% of your profits as part of the agreement you have between the two companies, well, you're obliged by that contract to, once you've settled all your other expenses, to pay that company whatever you have left over. Essentially, what that would do is give your company, your actual knitting company in the US, a $0 profit, but it would give your Cayman Islands account a profit of whatever they charged you for that agreement. Now, this is used by a lot of big companies. This is used by a lot of high net worth individuals to shelter their income. Now, this is what can be done. I am not condoning this in any way. I'm just letting you know with this last one specifically what has been done. And this is what many high profile people do to essentially shelter themselves from tax liability. That's really it. And there's one more thing I gotta tell you guys here, and that is gonna be that you need to subscribe to my channel or I will delete your Robinhood account. I'm serious. I'm seeing about 95% of the people that watch my channel do not subscribe, and we're gonna change that this week. So if you have not already, please subscribe. I post twice a week, awesome, solid content that can help you grow in your financial wisdom. I like telling you guys money stuffs, so please subscribe so I can tell you money stuffs. I really appreciate that. Anyways, that is it from me for this week, and I will see you next time.